What's up, everyone? Welcome back to a new show. I'm Andy Cruz.
I'm Brian Langeros.
And this is Will.
So this week, we're actually going to talk about two things. We have an announcement from Will, and then we're going to talk about bank failures, which is a big topic everyone's talking about. We're going to see what it means in the mortgage industry. But Will, start us off.
Yeah, hey, we got great news. We just found out that the Federal Housing Finance Agency has actually extended the LLPA, which is the level loan price adjustment.
Okay.
Nice.
So, which is good. What does that mean, Brian?
So, let me see. Basically, what it means is they're halting the hit on the interest rate for having a higher than 40% debt to income ratio.
That's correct.
Whoa.
Whoa.
He said like old school. He's like,
Dude, affordability, it's already hard, right?
yeah.
Yes.
Yeah.
And sometimes we can go and get people approved at a conventional, like at 49%,
Yeah.
right? Like, hey, we're kind of pushing right there. But now that's an actual hit to the interest rate, guys. That's pretty wild. Before it used to be credit scores
Yeah.
and the loan to value.
Loan to value, yeah.
But now, like,
Even
come on, guys. Like, are we
debt-to-income
trying to
ratio?
make it more difficult for home buyers to get into the market? I don't get this, Sandy.
So, where's the
Please.
benefit in this?
No, I think that's a great opportunity. I mean, again, like the market's already tight. That we're looking for more inventory. We're looking for rates to go down. We're looking for any like scrap of assistance we can get. So
Yeah.
the more assistance we can get, honestly, the better. So if this is a halt that's going to actually create opportunity for people, I welcome it.
So if you're looking to get into a home, this is the time pretty much. They
Yeah.
extended it till August. They really thinking they don't have a set date until when it's going to come into effect.
Okay.
But going now into the banking, I think that's what put the pressure
Probably.
on that adjustment.
Probably. I mean, this is probably the first of like a lot of other things we're going to see come out. I mean, this is probably a good transition
Yes.
into the conversation we're going to have today is we have to talk about banking collapses.
Yeah.
Now, I don't want to get in all the details of, at this bank it was this thing and that bank was that thing. All that information's out there. What I want to talk about at the table today is what does this mean for mortgages? What does this mean for our trusted institutions? What should our clients be thinking about? What should they be preparing for? And what should they be watching for on the horizon? Ready? Go.
Me. So, first off, one of the biggest, headlines that came out was SVB, right? And one of the reasons why they're saying that they collapsed was because of the fact that interest rates were being spiked up very
Right.
quickly, very fast by the Fed.
Right.
So what I say and what I feel and I've been hearing from what the research that I've been doing, listening, is that this might have a halt on the Federal Reserve's decision to raise rates upcoming, this next meeting. What I mean by that is that if this was to happen again and another bank falls and then another bank falls because of the rise in rates, now what type of problem are we speaking about now? Not just the mortgage industry. Now we're
Right.
talking about whole
Yeah.
mayhem in the economy,
Yeah.
world economy for that matter. So I feel that this can and possibly be a good thing for mortgage rates, as it could make the Fed's decision, slow down on the rates because of the fact that if they do raise them up, maybe another bank could fall, and we don't want that to happen. I'm sure the Fed doesn't want that to happen. But then again, we fall into a place where it's like, well, what about inflation then?
So, okay.
Forget about all that.
So it's like, yeah, we can talk about all this, but what about that right there?
part of the reason that risk was so risky for them is because they had too much holdings in federal in bonds.
Yes.
And that inverse relationship meant it was costing. So the higher the Fed was raising rates, it's costing them more and more. So they had to offload all these bonds to try to recuperate cash because they're just losing their shorts on it.
Yeah.
But when that happened and everyone caught wind, all these like big time depositors were like, boom, I'm taking
Let me get my
cash
money.
out.
Liquidity.
I mean, $42 billion.
That was me right away.
Yeah.
Hey, what I heard, and we're talking about SVB, right?
Yeah, yes.
Silicon Valley Bank.
Yep.
Just go in there, Google it, you'll understand. But there was people waiting in line to get their money out.
Oh yeah.
Like
Yeah,
there was
yeah.
lines, guys. There was lines. My buddy lives in that area. He said he went by one of their, and there was a line of people
Yeah.
waiting.
All over social
Let me
media.
get my money out.
Yeah. And you have people that had deposits there. A
Yeah.
lot of tech businesses that had
Yeah.
their payroll connected
Yeah.
to that. I mean, I won't
It's-
name the company,
what
but
an
there was a
effect.
company who was holding $490 million in cash in one single checking account at
goodness.
SVB. And remember, that's only FDIC insured up to $250,000.
Yep.
Except
Really?
when the bank put the backstop in right now, they just provided an emergency measure that they're going to cover all of the depositors.
Here we go again.
So I want to go back really quickly to what Brian was talking about. And One of the things I think that we have to be very careful of with the Fed is their increasing interest rates or stopping interest rates is going to send a massive signal about how worried they are about the banking system as a whole.
Exactly.
Because what have they been telling us for almost an entire year? They have three things they're focused on: putting inflation back to 2%, price stability in the markets, and a softening labor market.
Yeah.
Now, if you all of a sudden replace those three primary things they've been talking about for a year and go, oh, we got to save the banking system.
Here we go again.
What that says is, oh, this is a bigger problem we thought. Now, if they stick with their three things and they don't catapult the banking thing above it, then it means, okay, well, then maybe it's actually not that big of a big deal.
Right.
So I'm really curious to see what they say, because if Jerome kind of like dismisses it or maybe just doesn't give it a lot of attention, maybe they're actually feeling okay about things.
Yeah.
I mean, hey, the last collapse that we've seen on a major bank was Washington Mutual.
Yeah.
And you're talking about hundreds of millions of dollars.
Billions.
I mean,
yes.
Millions. Sorry, it was billions. Guys, this is SVB is also in the billions.
Yes.
Like, too big. Is this one of those, Andy? Too big to fail?
Well, it was the 16th largest bank in the United States. But here's the thing.
Too big to
that
fail.
means there's 15 banks bigger than it. But
Yeah.
the other thing, and this is some of the notes I was texting you guys, is that this sends a signal that's like, hey, if you have unintentionally or intentionally over leveraged a specific position and now you become in duress, we're just going to save you. And we had this problem already before.
We've seen it before.
And now everyone's having the same feeling about this time, even though the catalyst is different.
Yeah.
Before it was mortgage and real estate. Remember 08, 09? Front row seat to that thing.
We were the problem.
We were the problem, right? Or whatever. Okay. But now that's not the problem. And so that was the new problem, but it's causing the same outcomes of the government having to step in and do something about it. So I honestly think this is this is going to be the story of the year. We literally just did a show 2 or 3 weeks ago about what are the headlines in 2023 that are going to, be the things that are most important topics.
What a
all
slap.
those just got squashed.
Bam.
What a slap.
Bam. Bam.
Yeah, this thing's taking out all those things.
This is just
Who's
just crazy.
So who's paying for this? Who's paying for all this?
not the
that's-
taxpayers. It's not.
not the taxpayers.
It was an emergency fund that was there.
Right? That they
It has
allocated
an
$25
emergency
billion.
fund
But
at
where
the
did those
FDIC.
funds come from?
Everything goes
not-
back to the taxpayer, no matter how
Not
you
the
slice
taxpayers.
it. There's no such thing as government funded
Dang
because
it.
the government's funded by
I
the
thought we were
people.
gonna put a multiple choice right there.
Yeah, right?
What do you think,
What do you
audience?
think?
What do you think?
Oh, it's you, me.
No,
It's all of us.
Yeah.
That's all our monies.
So, Memo, what do you think this is going to mean for mortgages? What do you think that people's outlook should be in the mortgage space? Do you think we're going to see a pause? Is everyone going to just hold and wait and see what happens, or what?
Here's a crazy thing, guys. So SVB announced it that they're pretty much done, right? But yet 2 days later, they start originating loans.
Yeah, they got their backstop over the weekend, just like the last time.
So, you guys, confusion on top of confusion, but I guess everything's good, right? We're gonna get some type of bailout. So here we go, right? So what I think is gonna happen for mortgages is we've seen the difference. The market has actually been improving.
Mm-hmm. Yeah,
Right? The rates have been improving.
Yep.
Yeah.
So that's gonna give a lot more optimism to that
Yes.
buyer that's been on the
Yes.
fence. Let me take advantage of this.
Yeah.
That this is happening. So for me moving forward, I really think, again, if you're on the fence, now is the time.
Yeah. Right.
Go in there, start looking, go
I
get
think-
that.
I
I mean,
think
and
part
I'm
of that-
sorry. And
No, go ahead.
the other thing we've been hearing and we've been seeing, the rents are going up.
Yeah.
Rents continue to go up.
Yeah, you're
That's
going to
fact.
pay for housing. So are you going to pay for housing that someone else owns or housing you own?
So I'm just saying, all these things, I don't say things happen for a reason. In this case, things are happening for a reason for
Yeah.
certain people that are going
Yeah.
to take certain advantages of their situation.
So as we've been talking and teaching our audience through the years, is that when more money comes into the mortgage-backed security market, rates go down because it's supply
Yeah.
and demand.
Yes.
So the more of their money there is, the cheaper it is to lend. And when there's less money in the system, it's more expensive. So in this case, now there's this flight to safety. You see the flight to safety in gold and other commodities. You see
Yeah.
flight to safety in things that are considered secure. And that is why we're going to see mortgage rates go down proportionate
Yeah.
to their highs.
Yeah.
I don't think they're going to sink all the way back down to what we saw a
Yeah.
couple years ago because the fundamentals haven't changed at all.
Yeah.
what's still right now, the average rate is 6.6, right?
Yeah.
November was already at 7.2.
And
Yeah.
and I feel right now it's one of those windows in time where you should be, getting into the market because the rates are on the downturn. And I feel as, banks are needing to maybe, get money, they're going to have to low rates to get, money flowing into their accounts.
I will tell you something that I think got overlooked that is because of the shadow that this has cast on a bunch of other stuff is building permits and housing starts.
Yeah.
This last week, and I don't think anybody even saw this last week, those numbers both beat expectations by a lot. They're both better. So that means more building permits were filed and more housing starts were done than they had previously had the month before and expected this month.
Yeah.
So that means, to me, in 6, 9, 12 months, we're going to see more inventory on the market.
Yeah.
So that means based on Monday Mortgage Minute, we did get some good news on that.
We did get good news. Yeah. Because, we kind of wait and we're like, well, I mean, it's a toss-up.
Yeah.
Right now, it's like every week, it's like, oh, it's better than expected. Next week, it's worse than expected. But that one was a surprise.
Yeah.
Yep.
All I'm going to ask you guys is, where are you guys making your next $250,000 deposit? Or plus, right? Where?
My mattress?
Where?
Just kidding.
Yeah.
No,
Just kidding. Just kidding.
Yeah.
Because that's what I want to know. Like, I've been wanting to ask this question, you guys.
I was
like,
honestly thinking of just, rolling the dice and throwing it all in Bitcoin.
There.
Jeez.
Well, that's another.
man.
We got Signature Bank, right?
Yeah. Silvergate. Was it Silvergate or
No,
Signature?
no. It was actually Signature.
Signature was the
Bank.
one.
Signature
Okay, got
Bank
it.
was the one because of the cryptocurrency situation.
Yeah.
So there you go. We had the New York State officials went out there and let's close this. Seized it. Yeah.
Oh, okay.
So don't put in that one.
Dang
Okay.
it.
Let's find another bank.
I mean, at this point, I
Mattress
think
bank.
any bank that's open that's going to have FDIC insurance up to $250,000. That's the FDIC standing behind it. Even if it's a local community bank that fails, that's what the FDIC is there for. So I mean, I don't want to say, I can't say confidently. I really today can't say confidently go put it in any bank, but you kind of can also say that.
So here's the other thing, Andy. You were mentioning earlier that these banks, they're pretty much, their accounts are frozen, right? But they have payroll out of this. And only
these companies,
250,000's actually,
insured.
Correct? And so right now that this is happening, are those funds available to them? Like
They are
that's
right
something.
now. So
okay,
because
so they
of the
are.
backstop that happened over the weekend for SVB, they were businesses who were banking with SVB were immediately to go back to normal operations on Monday. I saw a couple of reports of people saying certain online features were unavailable because they're connected to other parts of the business, but their deposits and their checking and savings were accessible for spending against their payroll. They had to buy stuff for their company, pay bills. So that was still there.
Because these are for
again,
high-tech companies.
Yeah, they're for tech companies, but it's also not without consequence. I mean, this is coming up with a solution quickly over a weekend. Sound real familiar?
Yeah.
And so by Monday, things don't just
So the government
collapse.
does work on the weekend?
It's fun. Here's the deal. I'm gonna say this, and I texted you guys this. It was really interesting how fast they got some things done.
Yeah.
Isn't that interesting?
Yeah.
That's all I'm gonna say. I'm gonna leave it there. But man, they move quick on certain things when they want to.
Yeah. Oh my God.
Well, I'm just going to make a deposit there and continuing, right? I mean, hey, we have the support. So that's all we're looking for.
Andy, you mentioned something earlier that SVB was just the 16th largest bank, and there's 15 banks that are larger than it, right? So what happens, if this is just one domino that falls, do we foresee this possibly happen in other banks, or is it already happening and it just hasn't popped?
It's a great question. It has to do with two things, in my opinion. It has to do with their leverage, number one, because SVB was over leveraged in one specific position. That's kind of part A. Part B with that is, well, what does that leverage point have as a threat against it? So in this case, SVB was over leveraged when it came to U.S. government treasury bonds.
Yeah.
And then when the Fed started hiking rates, that is the direct threat. So when you look at, like, let's say your own personal investment in your retirement, what's they call mix of your portfolio, right? How much is savings, how much is bonds, how much is cash, how much is high yield, low yield, high risk, low, whatever. Well, all of these banks, they have their own portfolio makeup and their own mix of where they have money. So it really comes down to where they may be over leveraged in one position or not, and then what the threats to that one pain point might be.
Gotcha.
So that's my answer.
Yeah.
Blew out the water.
That's good. Yeah. Hey.
Pass.
And here's the thing that's also a little bit, here's the other thing that's a little
take two.
bit startling about that is that until it happened, it's almost like no one knew it was going to happen. Yeah. It was like, it just, boom, it happened. Almost like a light went off. Like, oh, like that fast? It just happened?
It's true. You know what? You mentioning that.
It was like literally out of nowhere. Big headline.
Right.
Yeah.
Everything's going to crash. Did you see anything where, like,
there was nothing in the horizon?
There's concern,
nothing like Everglade, right? Like we knew Everglade.
Evergrande. Yeah,
Evergrande.
Didn't
Like Evergrande.
SVB CEO just go on a run, getting a whole bunch of awards and a whole bunch of stuff, and then 7 months or 7 weeks after he got promoted to CEO, later.
Yeah, but also one of their risk management. One of their risk
they were without
advisors,
risk management for
that
like over
seat
8
was
months.
vacant for like 8 months. Yeah.
So that means like
see,
the risk
thing is
hide. That's everybody's cool. Everybody know how to manage
And I
risk.
think that's the part that's a little. I hate the best word I can
But
think
you
of is
can't blame it on
nefarious.
that, because obviously this is
Well,
what
but can you? I'm going to argue that. Can you?
Well, okay, so then that means that sole person or that sole department was just sole responsibility was to make sure that they mitigate risk.
Okay, let me ask you a question. So if for 8 months I didn't show up and do my work, would
dang.
anyone else
Yeah.
would anyone else here at Mortgage Heroes finally raise their hand and go, "Hey guys, this might be a problem. Andy's not here and we have no one doing our media and no one doing our business development."
Well, when you put it in that way, I think it'd be like
Easy.
Okay. Okay.
Yeah.
Guys,
So at some point,
guys,
as a manager, a supervisor, a board of directors, you have to go, wait a minute, this is a key position at our institution, and this person is missing. This job is going unfulfilled. So in this case, it's risk. But I'm saying if I was missing, I was the
That's
missing
why that
media
person
guy.
is hired for that position, is to
Yeah.
help us understand and have an overview as we move forward where we're at.
Thank you, Andy. Now I know for a
Does that
fact
make
we
sense?
can't let you go for
Yeah, no.
Thank you for.
I
Wow,
have
you're
to-
good. Reverse psychology.
I have to admit,
We have to scratch that conversation
you're
yesterday's.
asking- What I have to admit is what you're asking is a valid question.
Yeah.
Is like, is it really that person's fault? No, it's actually not just only one person's fault. It's many people's fault.
Yeah, of course.
Because if we let that happen here at our company and we go, oh, there's this huge, massive void that causes risk to our business and we don't address it, well, as leaders and owners of our own company here, we are responsible for that.
And that's, where I was going with it, where it's like, obviously, headlines and everything says, oh, we didn't have a risk mitigator. Well, okay, well, you still have a whole company. You still have a CEO. You still have this person. You still got that person. Like, how I don't think that's a valid answer.
I even saw Patrick Bet-David.
Yeah.
He having a conversation. He was saying that even as an insurance company back in the day, they had a compliance officer in his office, even though it's not required.
Yeah.
So he had a compliance officer to run before it even went to an actual compliance officer, so that there would not even be any compliance issues.
Yeah.
So I'm like, wow, okay, that's actually really long foresight down the time horizon.
So long story short, guys.
These are the people that have your money.
I mean, look, I can't tell you where to put your money, but
I know, and that's the thing that it's like, well, just try another one.
yeah.
And that's true. That's just like, where do you go now?
Yeah.
Go down the street to Bank of America.
Well, I think this conversation is going to continue to evolve. We might end up having to circle back to this again because every day there's like new information. There's another new bank. I don't want to get into all the other banks that have come up by name in the last couple of days because we need to wrap this one up. But I just think that we're going to end up having to talk about this again.
Absolutely.
The Fed meeting is coming up, and they're going to announce whether they have a rate hike or not. They're going to either talk about this bank collapses or not, and that's going to be very telling to us on what we should expect in rates, and we're going to have to deliver that back to our audience.
I'm excited to see what they're going to say now.
Hey, we should have popcorn at the office. Popcorn next week when Joe Powell hits the stage.
JP,
Papa.
back up to the plate.
Papa Pow. Papa
right.
Pow.
Well, thank you guys again for another great show. Thank you all for watching. Remember to like the show, subscribe to the channel, and we will see you again next week.
Next one.
That's it.